The US economy right now is sending pretty mixed signals. On one hand, you have the job market, which is clearly showing signs of cooling off, and tariffs have also been ratcheted up, which is raising costs for businesses. And on the other hand, you have American companies that are posting surprisingly strong profit margins. And the stock market keeps climbing higher week after week. So that leads us to ask the question, is this rally built on real strength, or is it balancing on a very thin thread? So here's what we know. Earnings season has delivered one of the biggest surprises of the year. According to FactSet, S&P 500 companies are on track to report around 12% profit growth in the second quarter alone. That's more than double what analysts were predicting just a month ago. And it's not just these numbers that they're reporting, it's the overall tone of the market and the surprising amount of optimism that we're seeing. Corporate executives have suddenly stopped talking about recession pretty much altogether. In fact, mentions of the word recession on earnings calls, which is something that we actually track, have dropped a staggering 84% compared to earlier this year. That shift in sentiment has helped push the S&P 500 up nearly 30% from its April lows near the tariff tantrum, and it's now up almost 10% on the year. However, this strength in the stock market that we're seeing is not evenly spread. Roughly 2/3 of the market's earnings growth is coming from just two sectors, and that's technology and communication services. Meta and Microsoft posted blowout quarters, riding the artificial intelligence wave. Nvidia is set to report later this month, and as the poster child of the AI boom, expectations are, as usual, sky high. Even companies that you might not think as tech, like GE Vernova, Comfort Systems, and Owens Corning, these companies are reporting strong results as well because their products serve the massive build-out of data centers needed to support this AI infrastructure. So while AI is creating a boom for certain industries, other corners of the economy aren't nearly as fortunate. And as we progress through time, this divide is just becoming clearer and clearer. Packaging companies, oil and gas drillers, and real estate investment trusts are all struggling. For example, Essex Property Trust blamed weak Los Angeles demand for soft earnings report, and its stock has dropped over 11% since. As Tim Murray from T. Rowe Price put it, we have a really bifurcated economy right now, and that's pretty accurate. Companies tied to AI and tech infrastructure are absolutely thriving, while many others are stuck in a sort of muddle through mode. Now, with companies as a whole posting strong profits, the health of the American consumer is the next big test. With big retailers like Walmart, Target, and Home Depot set to report, Wall Street will be watching those very closely to see if everyday spending can keep the economy afloat. Recent data has been mixed. We have seen job growth that has been slowed, but unemployment claims remain pretty low. Retail sales were stronger than expected, and inflation data is sending conflicting signals, showing that consumer prices cooled, but wholesale inflation ticked higher. So again, we're having this interesting dichotomy play out within the market right now. Even in travel, uncertainty has given way to a pretty strong rebound. United Airlines CEO noted that demand turned sharply higher once trade deals were settled and tax cuts passed, reducing policy uncertainty. People just are fine with traveling again now that we have clearer skies, metaphorically. Airline stocks, which have now been down for most of the year, staged a rally last week after airfare prices rose and Spirit Airlines warned it might shut down. Again, interesting dichotomy here. And this leads to overall investors getting nervous. Stock prices look stretched. The S&P 500 is currently trading at about 22.5 times forward earnings compared with the 10-year average of just 18.8. Now, what this means is that stocks are pricing in a near perfect future. As Bob Dahl at Crossmark Global Investments put it, we are in a high-risk bull market. Stocks are discounting a near perfect world, and it is not perfect right now. So right now, markets are essentially betting that strong corporate earnings, especially from the AI boom, which are spread out between just a handful of companies, that those earnings can outweigh weaker jobs data, higher tariffs, and lingering inflation. All things that we're starting to see bubble to the surface right now. It is ultimately a balancing act, and as long as those companies can keep beating expectations, investors will likely keep buying, especially as we go into the rate cut season, which is just around the corner from the Fed. It's also fragile though. With valuations this high, there is extremely little room for mistakes. One disappointing earnings season from something like Nvidia, a surprise jump in inflation, or a shock to consumer spending could easily break this entire rally's momentum. So to answer the ultimate question, yes, the stock market's resilience is real. It's not just a facade, but it's very unevenly weighted, and it's pretty risky right now. Optimism is deserved in some parts of the economy, like tech and AI, like we talked about, but for the broader market, it may very well be optimism held up by a thread. So continue to monitor those things. Keep an eye on corporate profit margins, what inflation is doing, what the unemployment claims look like, and if rate cuts are still on the table in the September Federal Reserve meeting, which right now it's looking like they are. So that is probably going to be a huge bailout, assuming that that goes according to plan. But you need to keep an eye on that, because if that changes, then that will likely change the narrative for a lot of other sectors. If you guys like this type of content, make sure to leave a like, drop a comment letting me know your thoughts, and make sure to subscribe so you can stay up to date on more videos like this in the future. See you guys in the next one. Peace.